In this video you are going to learn market risk. Topics I have discussed are meaning of market risk, characteristics of market risk, types of market risk, how to manage market risk, advantages of market risk, and disadvantages of market risk. Let's start the video. The uncertainty associated with any investment decision is called market risk or systematic risk. Market risk is the possibility for an investment's value to decrease due to changes in the market, such as fluctuations in interest rates, currency exchange rates, commodity prices, or stock market movements. This risk is inherent in all investments and is caused by external factors that are beyond the control of the investor. So it is required for an investor to monitor every macro variable, such as inflation, interest rates, the balance of payments, geopolitical factors, and fiscal deficits, which are related to the financial market. Characteristics of market risk. Market risks are unpredictable. Market risks are caused by factors that are beyond an investor's control, such as changes in economic conditions, geopolitical events, and natural disasters. These events can be difficult to predict. Market risks affect a wide range of assets. Market risks can affect a wide range of assets, including stocks, bonds, commodities, currencies, and real estate. Market risks are a type of systematic risk, which means they affect the entire market or a particular segment of the market. Systematic risk cannot be diversified away through asset distribution. Market risks can lead to significant losses. It can lead to significant losses for investors, particularly if they are heavily invested in a separate asset or sector. Market risks can be managed. While market risks cannot be eliminated entirely, they can be managed through diversification, hedging, and other risk management techniques. Investors can also limit their exposure to market risks by carefully selecting investments and monitoring their portfolios. I have discussed risk management in a separate video. I will put the video link in the description and in the I button. There are several types of market risks that investors should be aware of. Here are some of them, with examples. Number 1. Equity risk. Equity risk is the risk that the value of a stock or equity investment will decrease due to factors such as changes in market sentiment, company performance, or industry trends. For example, negative news about a company's financials or management could lead to a decline in its stock price. 2. Interest rate risk. Interest rate risk is the risk that changes in interest rates will affect the value of fixed income investments such as bonds. When interest rates rise, the value of existing bonds may fall, as new bonds offer higher yields. Conversely, when interest rates fall, the value of existing bonds may rise, as new bonds offer lower yields. Number 3. Currency risk. Currency risk is the risk that changes in foreign exchange rates will affect the value of investments denominated in foreign currencies. This risk is particularly relevant for investors who hold investments in foreign markets or who invest in multinational companies. 4. Commodity risk. Commodity risk is the risk that the value of investments in commodities such as gold, oil, or agricultural products will fluctuate due to changes in supply and demand or geopolitical events. For example, a drought could lead to lower crop yields and higher food prices. 5. Systematic risk. Systematic risk is the risk that affects the entire market or a particular segment of the market. Examples of systematic risks include changes in economic conditions, geopolitical events, and natural disasters. Number 6. Unsystematic risk. Unsystematic risk is a risk that is specific to individual security or a particular industry. Examples of unsystematic risks include changes in company management, product recalls, and patent disputes. Let's discuss how to manage market risk. There are several ways to manage market risk. Here are some of the best methods. Diversification. Diversification is one of the most effective ways to manage market risk. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce their exposure to any single risk factor. Asset allocation. Asset allocation involves determining the appropriate mix of investments based on an investor's risk tolerance, time horizon, and financial goals. By balancing different types of assets, investors can reduce their exposure to market risk while still achieving their desired level of return. Hedging. Hedging involves using financial instruments such as options, futures, or swaps to protect against potential losses. For example, an investor may purchase put options on a stock to hedge against a decline in its value. Stop-loss orders. A stop-loss order is an order to sell a security once it reaches a certain price. This can help to limit potential losses in the event of a market downturn. Active management. Active management involves regularly monitoring and adjusting a portfolio in response to changing market conditions. Last one is maintain a long-term perspective. It's important to remember that market fluctuations are a normal part of investing. By maintaining a long-term perspective and focusing on long-term financial goals, investors can avoid making impulsive decisions based on short-term market volatility. Market risk is a critical component of investing, and it has both advantages and disadvantages. Here are some of the main advantages and disadvantages of market risk. Advantages of market risk. 1. Potential for higher returns. Market risk is often associated with higher potential returns. Investors who are willing to accept higher levels of risk may be able to earn higher returns than those who only invest in low-risk investments. 2. Liquidity. Market risk is typically associated with investments that are publicly traded, such as stocks and bonds. These investments are generally more liquid than private investments, meaning that investors can buy and sell them quickly and easily. 3. Transparency. Publicly traded investments are subject to regulatory oversight and reporting requirements. This means that investors have access to a wealth of information about their investments, including financial statements, earnings reports, and analyst ratings. Let's move on to disadvantages of market risk. Number 1. Losses. The most obvious disadvantage of market risk is the potential for losses. When market conditions change, investments can lose value, and investors may not be able to recover their initial investment. 2. Volatility. Market risk is often associated with high levels of volatility, meaning that investments can experience large fluctuations in value over short periods of time. This can make it hard for investors to predict the prospective value of their investments. 3. Complexity. Investing in the stock market can be complex, and it requires a high level of financial literacy and knowledge of market trends. This can make it difficult for inexperienced investors to make informed decisions. In summary, market risk is an important consideration for any investor who wants to participate in financial markets. Understanding market risk and how to manage it can help investors make informed decisions and achieve their long-term investment objectives. If you want to read it in details or download the PDF, go through the link in the description. To suggest me any topic, feel free to send it on Instagram or by email. Like the video, and don't forget to subscribe to Educationleaves.